Hi everyone. In October 2019, imagine two nurses worked at the same Beirut hospital for a decade. Both saved exactly $50,000. Both were disciplined savers. One deposited her money in a Lebanese bank, earning 7% interest. The other converted to US dollars and stored them outside the banking system. 3 years later, Nurse One's account still showed $50,000 in Lebanese pounds, but that bought a used motorcycle. Nurse Two's dollars bought a 3-bedroom house. Same starting point, opposite endings. The only difference? Which pieces of paper they trusted. I'm about to show you the 3-asset formula that separates these two outcomes and why one specific ETF most investors overlook might be the most important position you ever take. Right now, it's sticky inflation holding at 2.8% and market volatility climbing as tariff threats resurface. Investors are being reminded that the purchasing power of cash isn't guaranteed. Every investor thinks their government-issued money is special, permanent. That's precisely what Weimar Germans believed in 1922, what Zimbabweans believed in 2007, what Venezuelans believed in 2014. All watched their life savings evaporate, not because they were foolish, but because they didn't understand the mathematics of currency breakdown. Here's the formula that plays out identically every single time. Governments spend beyond what they collect. To bridge the gap, central banks create new units. As supply floods the economy, each unit purchases less. Citizens notice prices rising faster than wages. Smart money flees to alternatives. The final stage arrives when faith breaks and the entire system resets. But here's the counterintuitive insight that saves fortunes. When domestic currency dies, ownership stakes in real businesses don't automatically disappear with it. During Venezuela's currency collapse, their stock market index rose more than 16,000%, while the bolivar became wallpaper. Why? Because equity shares represent claims on actual factories, patents, equipment, land, real assets that maintain value regardless of which paper the government prints. But not every business protects you equally during these transitions. Imagine two Venezuelan companies. Company A operates retail stores selling exclusively to local customers, collecting 100% revenue in dying bolivars. Company B manufactures goods for export, earning half its revenue in dollars from American buyers. As the bolivar implodes, Company A's real profits evaporate. Company B's dollar revenue stays stable, while its bolivar-denominated local costs essentially approach zero. Real profit margins explode. This is where most investors miss the trade hiding in plain sight. The Schwab U.S. Dividend Equity ETF, the ticker is SCHD, owns 100 multinational corporations generating revenue across dozens of stable jurisdictions. Chevron operates in Kazakhstan, Australia, and Nigeria, extracting crude that sells worldwide for dollars. Merck distributes medicine across Europe, Asia, Latin America. Lockheed Martin exports fighter jets to NATO allies paying in euros, yen, pounds. ConocoPhillips pumps oil from fields spanning 4 continents. These aren't domestic businesses vulnerable to single jurisdiction breakdown. They're global profit engines that thrive during currency transitions. The mathematics are stunning. Over the past decade, early investors saw their initial position grow roughly 240% in total value. The annual compounding rate averages approximately 12 to 13%, including reinvested distributions. But here's the part that changes everything for income investors. The quarterly distribution hasn't just held steady. It's increased every single year for over a decade straight. If you bought shares early, your yield measured against your original purchase price now exceeds 10%. The distribution that started as pocket change has multiplied over 500% while you own the same shares. Let me stop you before you make the mistake I see constantly. You're thinking, but SCHD holds boring companies, energy stocks, healthcare, consumer staples. Where's the growth? You're confusing entertainment with wealth preservation. Boring means these businesses maintain pricing leverages when chaos erupts. When Turkish citizens couldn't afford imported electronics, they still bought necessities, just paid more lira per item as their money died. When Argentine inflation hits triple digits, people still needed medicines and basic goods. Prices just adjusted upward. When Lebanese banking froze, payment processors still collected fees whether paid in strong or weak currency. These sectors don't just endure currency breakdown, they profit from it. The expense ratio sits at 6 basis points. That's $6 annually per $10,000 invested. You're getting automatic access to 100 globally diversified businesses that rebalance each year based on dividend quality and financial strength. Now I know what you're thinking. Yes, SCHD sometimes underperforms growth indexes during bull markets. That's not weakness. That's the entire point. You don't buy fire insurance hoping your house burns down. You buy it so you're protected when disaster strikes. But SCHD alone isn't enough. You need two more pieces. The first is precious metals, specifically gold or silver. Governments can print unlimited amounts of their paper. They cannot print gold. When Turkish authorities flooded their economy with lira, citizens who held gold maintained purchasing power entirely. When Lebanon's pound collapsed, those who converted to gold preserved wealth. The metal doesn't need earnings reports or dividend growth. Its entire function is being impossible to debase. But metals carry risks too. They generate zero cash flow. That's why you allocate modestly. 10 to 15% maximum, purely as insurance. The third piece completes the formula. Access to stable foreign alternatives. International brokerage accounts, holdings dominated in euros or Swiss francs, even cryptocurrency stablecoins pegged to functioning currencies. The goal is simple. Don't trap 100% of your wealth in one jurisdiction's paper. Lebanese citizens with dollar accounts offshore maintain their net worth. Argentines holding euros in European banks preserve capital. Venezuelans with Miami real estate escape Bolivar devastation. Here's how to implement this based on where you are in life. Ages 35 through 45, allocate 60% to SCHD for defensive equity exposure with growing income. Add 30% to broad market indexes for participation in growth. Include 10% in physical gold or a gold ETF as insurance. Ages 50 through 60, shift to 50% SCHD as your foundation. Add 20% to investment-grade bonds for stability. Keep 20% in diversified equities. Maintain 10% in precious metals. Over the age of 60, position 60% in SCHD for the distribution stream that increases annually. Add 25% to high-quality short-term bonds for liquidity. Include 15% in gold for insurance. Your priority is cash flow that rises faster than inflation while protecting capital through multinational business ownership. Here's what financial advisors won't tell you because it conflicts with how they get paid. True diversification requires holding different forms of value that respond differently to currency stress. A portfolio of 100% domestic stocks, denominated exclusively in one weakening currency, faces catastrophic vulnerability. Adding bonds in that same failing currency doesn't create protection, it doubles down on identical risk. SCHD combined with hard assets and foreign alternatives creates actual defense because each component responds differently to currency breakdown. Stocks and companies earning global revenue rise with inflation. Precious metals preserve purchasing power through scarcity. Foreign holdings provide escape routes. This isn't about predicting collapse tomorrow. It's about positioning for whatever comes, bull market or crisis. So you win either way. The question isn't whether governments will eventually face currency pressure. History proves all fiat arrangements eventually do. The question is whether you'll be positioned as Nurse 1 or Nurse 2 when mathematics reasserts itself over political promises. If this framework changed how you view portfolio construction, subscribe now. In the comments, tell me your biggest concern about implementing the strategy. I respond to every legitimate question with specific guidance. The formula is proven across a century of currency transitions. The only variable is whether you act before the next reset or become another cautionary tale of what happens when you trust paper over planning. This content is educational, not financial advice. All investments carry risk, including potential loss of principal. Consult a qualified professional before making decisions. This is Invest ED, building wealth the boring way that actually works. Smash that like button and subscribe for strategies Wall Street won't tell you. Smart investing, profitable results.